Problem 10-31. We're going to do full depreciation schedules using StraightLine, units of production, and double declining balance for a truck. Now, a full depreciation schedule just means you're going to calculate the depreciation over the life of the asset. So on January 3rd, Fast Delivery Service purchased a truck that cost $62,000. Before placing the truck in service, Fast spent $3,000 painting it. So because that's part of the cost of getting the truck ready for its intended use, that is considered part of the cost of the truck and will have to be capitalized, which means it's put in that truck account, the asset account called truck, and it will also eventually be depreciated. Also, they had to buy $1,500 to replace tires, and they spent $3,500 overhauling the engine. All right, so those were all costs that were necessary to get the truck ready to use for the very first time. Therefore, they are all part of the cost of the truck. So the total cost of the truck includes the purchase price of the truck, the painting, the tires, the engine overhaul, for a total of $70,000. So the cost was $70,000. Now notice on January 3rd, that's what this row is for. So on January 3rd, the day that we buy the truck, what is the book value? Remember, book value, the formula for book value is cost, $70,000, minus accumulated depreciation. On the day that we buy the truck, do we have any accumulated depreciation? No. So the book value of the truck is $70,000. Now we have to fill in the row for the end of the year. So the first thing on our depreciation schedule, which in the real world you just do this in Excel, is depreciable cost. So what is depreciable cost? Depreciable cost is the most you could ever depreciate of that asset. And that means cost minus the salvage value or residual value. Residual value and salvage value are the same thing. So you cannot depreciate the salvage value. So let's see if this thing has a salvage value. It says the truck should remain in service for 5 years and have a residual value of $5,000. So the most we could ever depreciate of the truck is the cost, $70,000, minus the $5,000 residual value. So that gives us a depreciable cost of $65,000. Now a depreciation rate. So in this method, we're using the straight line method. So the formula for depreciation, remember, is cost minus the residual value. So that's what this $65,000 is. It's cost minus residual value divided by the useful life of the asset. And the useful life of the asset is 5 years. So $65,000 divided by 5 years gives us $13,000 of depreciation per year. Now we're going to, even though we bought this technically on the 3rd of January, we're going to record a full year depreciation. The reason why is because we bought this in the first half of January, so we will consider January a full month of depreciation. And then what is our accumulated depreciation in the first year? It's the same as the depreciation expense, $13,000. And book value, the way we calculate book value is we take the cost, $70,000, minus the $13,000 of accumulated depreciation. So book value is $57,000. In the next year, our depreciable cost remains the same. In fact, if we wanted to plug this in for each number, we could do that. And we're always going to divide by 5 years. And in fact, the depreciation, because of straight line, it's going to be the same every year. And our accumulated depreciation for the second year we had 13,000 plus 13 more thousand gives us 26,000. And then in the third year, it's 26,000 plus 13,000 gives us 39,000. In the fourth year, we're going to take the year's previous accumulated depreciation, 39,000, plus the new year's depreciation, 13,000, gives us 52,000. And then the last year, we're going to have 52,000 plus 13,000 gives us 65,000. Now notice we depreciated the maximum amount that we could ever depreciate of this vehicle, which is 65,000. Again, we got the 65,000 by taking the 70,000 and subtracting the residual value of 5,000. Then the last thing we need to do is fill out our column for book value. So the book value, remember, is the cost, 70,000, minus accumulated depreciation of 26,000, and that gives us 44,000. Another way to calculate this is just going to decrease by the amount of depreciation each period. But I'll do it by the technical way we calculate book value, which is cost, 70,000, minus our accumulated depreciation of 39,000 gives us 31,000. In the next year, we've got costs of 70,000 minus 52,000 gives us 18,000. And then last year, we've got cost 70,000 minus accumulated depreciation of 65,000 gives us 5,000. So in this last year, the book value should always be equal to our residual value. And that's true. Now we're going to calculate depreciation for the same vehicle using units of production. Now, in the real world, you would just choose one of these methods for the asset, and then that you would stick with it. You do not have to calculate different types of depreciation for the same asset. We're just doing this using 3 different methods so we can get practice. Also, a realistic example why you might do this is your boss might say, why don't you create a depreciation schedule for each of the 3 different types of depreciation methods that we're thinking about using, and then we will review the results to see which one we want to choose for this asset. So before beginning the units of production depreciation schedule, remember units of production is how much the depreciation is based on how much you use the asset. And how do we measure how much we use a truck? It's miles. So basically what we're doing is we're going to calculate depreciation per unit, which is per mile. So the formula for that in words is we're going to take cost minus the residual value. And we already know the cost is 70,000. The residual value is 5,000. And so this together, 70,000 minus 5,000 gives us that same depreciable cost amount. Depreciable cost, 65,000. And then we're going to divide that by the useful life in units. So how many miles do they think this truck can last? Up here it says the truck's annual mileage is expected to be 28,000 for the first 4 years, each of the first 4 years, and 18,000 in the 5th year, for a total of 130,000 miles. So we're going to divide by 130,000 miles. So let's see what that turns out to be. So we've got, 70,000 minus 5,000, we got 65,000 divided by 130,000 equals 0.5, so 50 cents per mile. Now it says round the depreciation expense per unit to 2 decimal places. Well, this one's already 2 decimals, 0.50 or 0.50. So this gives us 50 cents per mile. If this was 0.509, then we would have to round that to 51 cents. And if it was 0.501, we would round that down to 50 cents. But we got lucky and there is no rounding required. Now we're going to do the depreciation schedule for units of production. So again, asset cost us $70,000. So same as up here. Copy and paste. The book value on the day that we buy it, January 3rd, it's still $70,000. Now depreciation per unit, we know this is 0.5 or 0.50 or 0.50. They're all the same. And then we have to fill in how many miles we expect to drive this truck. So we expect to drive the truck 28,000 miles in each of the first 4 years. So we got 28,000. We copy and paste that. And then in the 5th year, 18,000. Now all of these miles need to equal 130,000. So let's double check that. So we got 28,000 times 4 equals, so we got 112,000 plus 18,000 gives us 130,000. So they did that correct. Now we can calculate the depreciation expense. So 0.5 times 28,000, well, in other words, what's half of 28,000? That's 14,000 in each of the first 4 years. And then in the last year, we got half of 18,000 is 9,000. Accumulated depreciation. The first year, it's going to be 14,000. The next year, it's going to be 14,000 plus 14,000 more, gives us 28,000. The third year, it's going to be the previous year's accumulated depreciation. 28,000 plus 14,000 gives us 42,000. And the next year, we've got 42,000 from the prior year, plus 14,000 more, gives us 56,000. And then the last year, we have 56,000 plus the last year's of 9,000, gives us 65,000. And this, the accumulated depreciation in the last year should equal the depreciable amount. The depreciable amount, again, is the asset's cost, 70,000, minus the truck's residual value. Now we can calculate the last column, which is book value. Remember, book value is the cost of the asset, 70,000, minus the accumulated depreciation. So at the end of the first year, it's 70,000 minus 14,000. So that is 56,000. The next year, we've got the cost of 70,000 minus 28,000 gives us 42,000. The next year, we've got 70,000 cost minus 42,000 gives us 28,000 book value. The next year, we've got a cost of 70,000 minus 56,000 gives us 14,000. And then last year, we've got 70,000 costs minus 65,000 accumulated gives us 5,000. And again, the book value in the last year needs to be equal to the residual value, which was 5,000. And then the last technique that they want us to use is double declining balance. So again, our asset cost is the same, 70,000. And the book value on the day we buy it is also 70,000, because book value is cost minus accumulated depreciation. And then remember, the formula for double declining balance is taking the book value. The book value, again, is the cost minus accumulated depreciation. So that's the book value. So we're just going to take this same book value and plug it in here. And the double declining rate means you're going to take 2, I multiply it by 1 divided by 5. And the 5 represents the 5 years that you are going to be depreciating this asset, the life of the asset. So basically, you're taking the book value, multiplying it by 2, and then dividing by the number of years. So that gives us a depreciation expense of $28,000. And that means our first year's depreciation is the same. Our first year's accumulated depreciation. So what is our book value? In this year, to calculate book value, take your $70,000, subtract your $28,000, that gives us $42,000. In the next year, we need our book value. So the book value for this next year is the same as the book value for the previous year, ending book value of the previous year. So that's $42,000. Multiply it by 2, and then divide by 5, and that gives us $16,800 of depreciation. So accumulated depreciation in this year is going to be the previous accumulated depreciation plus this year's depreciation. It gives us $44,800. Book value is going to be the cost, $70,000, minus accumulated depreciation of $44,000 gives us $25,200. And then so we take this book value and it carries over to the book value at the beginning, or for the calculating the next year. And we're still going to multiply by 2, then divide by 5. So 25,200 times 2 divided by 5 gives us 10,080. And our accumulated depreciation for this year is going to be the previous accumulated depreciation plus this year's depreciation, which gives us 54,880. Which means our book value for this year is going to be the cost, $70,000 minus 54,880, which gives us 15,120. So we're going to carry this over, bring it down here as a book value for this next year's calculation, still multiply by 2, divide by 5, and that gives us 6,048 of depreciation. So to calculate accumulated depreciation here, we're going to take the prior accumulated depreciation, add this year's depreciation. So we get 60,928. And our book value here is going to be the cost minus accumulated depreciation gives us 9,072. Now, you may be wondering why we don't have the book value and the double declining balance right here. Well, the reason why is, remember, this last year, this book value has to equal the asset's residual value. So we can plug in 5,000. I'm going to just copy it from here. So we need to plug it in here. So how do we get from 9,072 book value down to 5,000 book value? Well, that must mean that the depreciation expense for this year, the final year, is the 9,072 minus 5,000 gives us 4,072. And now to calculate the accumulated depreciation, we're going to take the 60,928 plus 4,072 gives us 65,000. Now remember, this 65,000 had to be the depreciable cost. Again, the depreciable cost is the cost of the asset, 70,000, minus that residual value. So this last number has to always be, for accumulated depreciation, it has to always be the maximum amount you could depreciate, which is, again, asset cost minus the residual value. And the book value in the final year has to be equal to the residual value. So on double declining balance, this number, you're just going to calculate it. It's called the plug number. Whatever number is going to make it fit, you plug it in here. All right, then let's take a quick look at these different depreciation methods. So the first one is straight line depreciation. We call it straight line because the depreciation expense right here is the same every year. It creates a straight line if you created a graph. Double declining balance, it's going to vary depending on your miles. And as your miles vary over here, your depreciation expense varies here. And double declining balance, its biggest feature is that it gives you a ton of depreciation expense in the beginning, but it quickly falls. So the last thing they're going to ask us is, it says FAST prepares, FAST is the name of the company, FAST prepares financial statements using the depreciation method that reports the highest net income in the early years. So their goal is to create the highest net income in the early years. It says consider the first year that FAST uses the truck. Identify the depreciation method that meets the company's objective. So if we want a high net income in the first year, do we want high depreciation expense or low depreciation expense? Well, we want low depreciation expense. So let's look at the first year depreciation with these three methods. We got 28,000 for double declining. We got 14,000 for units of production, and then we've got 13,000 for straight line. So this company, since their goal is high net income, they want to use the straight line depreciation because it produces the lowest depreciation expense and therefore the highest net income. So now, some companies do not want a goal of a high net income in that first year. Some want to minimize taxes. So in that case, to minimize taxes, you would want to use the method that creates the most depreciation in the early years. So in that case, it would be double declining balance because that's 28,000 versus 14,000. And that's it.